Hi everyone, this is Shomodeep. Second, I'll just make it full screen. Yeah, welcome to my channel SR Trades. This is literally my first video, so apologies if I'm making any mistake. I'm not gonna cut through my mistakes and all. I'm just gonna keep it here, so that I can learn from these later. Okay, let's get started. Today's topic is gotta be why should you invest? Now, before that, I'm gonna give a small intro of myself. Who am I? Why am I here? What am I trying to teach? What am I trying to show over here? Just use a marker, it'll be easy. Okay, my education background, I've done engineering, mechanical engineering. Career turned from engineer to trader. If I tell you about this, so in 2021, I think I was in my second year of college. I was just scrolling phone, and I thought of that. Okay, what can I do so that I can earn money from home? When I googled it, the first thing which came on my search list was trading. That is exactly where it began. What is my trading style? My trading style is usually positional and swing. In simple terms, if I say, just a second over here, positional and swing trading, that means I hold the stocks for almost 2 months, 3 months, 4 months, depending on how much the momentum is going to sustain in that particular stock. I'm a momentum trader. I don't usually trade any pullback or anything. I just trade in the stocks where I see momentum. Otherwise, I don't. Experience, I also worked in a company. I worked as an equity research analyst for almost 2 years, and now finally it's time to start something new. So that's why SR Trades is here. By the way, in SR Trades, I'm going to cover a lot of topics and mainly on finance and trading. It's a part of this, thus investing. Let's get started with today's topic. Okay, so why should you invest? I hope you guys have noticed a very common pattern in today's people, which is I'm talking about the corporate culture. Your salary comes in, you spend your money, you save a little bit, and you just feel responsible. I know nowadays you guys have been looking at a lot of reels and all, you know about investing, but no one knows why. People know, okay, I should invest, but the reason why you need to invest, that is what I'm trying to crack it down over here. When you're saving your money, let's use black. I think black suits it better. When you're saving your money in any savings account, okay, you get around 2 to 3% per annum. Now, 6% is the inflation rate. Okay, before I come to this part, I'll just explain what is this inflation thing. Think of this, that before 10 years, that means in 2016, with 100 rupees, you could have got 10 ice creams. But now, with the same 100 rupee note, you can just buy 5 ice creams. Okay, they look big over here, but that was not the point. The point was that you could have bought 10 over here, now you can only buy 5. That's the difference. This is very simple addition of how the inflation works. Now think of it. That means if you have 100 rupees in your bank account, after 1 year in your savings account, that is becoming around 103, let's say. And because of inflation, that means with 100 rupees, you could have bought, let's say, 10 chocolates over here. And now, 103 rupees, because, okay, let me just link this inflation over here. 100 rupees, inflation is 6%. That means the value of 100 rupees becomes 94. Okay. You can now understand the difference that, okay, inflation means the 100 rupee note or the 100 rupees, it's just losing its value over time. Now with 10 rupees you're getting, sorry, 100 rupees you're getting 10 ice creams, but with 102 103 rupees you'll probably get 9 or something. Like overall the number should be reduced. We'll come to this part later when we'll do the calculation thing and all. It'll be very easy. So what is happening if you're keeping your money in your savings account? It's just losing its value over a period of time. That is the most simplest version of how can I explain the idea of inflation. Just keep this in mind. This is the most easiest way of explaining inflation to anyone. I don't think I should be using numbers and all. These numbers will just make people crazy. This picture, there's a there's a line, no? Picture is equivalent to 1,000 words or something like that. This is exactly what I'm trying to say over here. Now, the savings account, like, let's say you have a salary of 50,000 rupees, your monthly expenses are around 40,000 rupees. You can save only 10,000 rupees. If you keep the 10,000 rupees in your savings bank account, after 10 years, this is going to be your interest earned. This is your investment. This 12 lakh means you're investing 10,000 monthly. Think of it, 10,000 monthly. So in 12 months, you're going to invest 1.2 lakh, and 1.2 lakh in 10 years, it's becoming 12 lakh. Okay. And this is the interest you're gaining on this capital, and this is your net value after 10 years. On the other hand, instead of keeping it in savings account, if I start investing the money, now there are various asset classes which will be covering in the upcoming lectures or upcoming videos of these of this channel. For today, I have been using very simple index fund, Nifty 50. I'll also explain what is Nifty 50. I'll just explain it over here. Imagine how to break it down. Okay, let's see. So Nifty 50. Okay, imagine a supermarket. Okay, this is what your stock market is. Stock market. I'm just comparing it with the supermarket. Okay, in the stock market, there are thousands of companies which are listed. You can go and buy any company share and all. We'll be having lectures on these particular topics in the upcoming series of this SR Trades investing series or something. Over here, what I'm trying to say is, let's assume you have a supermarket, and in supermarket you can buy shares of stock. Yeah, shares of stock you can buy it from the supermarket. Now think of Nifty 50 over here. Nifty 50 means if I just give you a basket of the top 50 companies in the market or the supermarket, that's what I'm saying. The top 50 companies of the market is what I'm talking about. So Nifty 50, in simple words, it is basically an index. Imagine it as a basket having the top 50 companies of India, in simple words. We'll come to this later. How can we invest 10,000 and all? We'll come to this part later. So again, I've used the same metrics: 50,000 salary, 40,000 expenses, 10,000 investing. I've taken returns to be very conservative, around 12%. Usually, you get 14 to 15% returns per annum. Okay, I've used 12. Now, with 12% returns, future value here comes out to be 23 lakh. On the other hand, here it was 14 lakh. You can see the difference over here of 9 lakh. You can understand that if I just simply keep my money over here, just buy Nifty 50 index fund, or there's a, yeah, you can just buy this and your value goes plus 9 lakh in 10 years. On the other hand, if I just invest the same amount of money for 20 years, this is for savings account at 3% interest rate, it becomes 32 lakh. On the other hand, same amount for 20 years, invested 24 lakh. Here also the investment was same, by the way, 24 lakh. This 32 lakh after 3% interest, 12% interest. This is what you get, almost a crore. As you can see, the difference over here, 67 lakh rupee. That's a big number if you consider it today, but not a big number if you consider it after 20 years. Anyway, the main idea over here was the idea of compounding. Now, let me just explain all of these things. So, right now, I'm going to explain the cost of waiting. What is this thing? I've taken two scenarios, okay? There are two investors. I'm going to explain this idea of compounding very easily. So, please make sure that you're paying your full attention over here. Cost of waiting. Two investors, same 5,000 rupees per month. Um, this is the first person, second person. Here, person A. Person A starts doing a monthly SIP, or instead of SIP, because I've not told about SIP yet, take it as investing. If you invest 5,000 rupees monthly for 10 years, okay, and after that you stopped, okay, you just stop, So let's say this person is starting at 22 and 10 years investing 5,000 rupees a month. So total invested will be 6 lakh as 5,000, 12 months that's 60,000, 10 years that's 6 lakh rupee. Okay. This guy invested for 10 years. After 10 years, he stopped investing. Money is just growing on its own. Okay. Person B, okay, there's a little bit mistake over here. This will be here. Person B, he had a different mindset. So what person B did, instead of investing his money early, he used that money for his lifestyle or maybe partying or maybe something else. I'm not telling you not to party. Please don't get me wrong. So it's like so this guy starts at 32 years and he invests straight for 30 years, okay, and never stops. Can you see the difference? This guy invested from the age of 22 to 32. This guy started investing from the age of 32 till 62. Same amount, 5,000 rupees a month, 5,000 rupees a month. This guy invested only for 10 years. This guy invested for 30 years. 30 years, that means the amount is also more. This guy invested 6 lakh, person B invested 18 lakh. Now, I'm just going for the result now. You'll be shocked to know that after, not after, at the age of 62, I've taken 12% returns, okay? Person A will be having 3.5 crore, whereas person B will have 1.76 crore. This guy invested only 6 lakh rupee, only invested for 10 years, then stopped. This guy invested for 30 years, right? 30 years. Invested for 30 years, it's written here, 30 years, invested 18 lakh rupees. Still less. Can you understand the difference? Person A invested 3 times less money for one third the time and ended up with 2x more. Why so? This happens because of compounding. Compounding rewards time, not money. The damage is exponential, not linear, as you can see. So, compounding, when we go through the graph of compounding, it just does this. Delaying 1 year doesn't cost 1 year of return, it costs the compounding of every future year stacked on top. We'll use these, I think this is the last one over here. So early money has the longest run. As you can see from the example, 5,000 rupees per month for 10 years versus 5,000 rupees per month for 30 years. But that was done later and it was done early. That simply means if you're looking to gain the full advantage of compounding, all you need to do is start early. The first best time to start investing and all was definitely in your past, but the second best time is now, so you can start it now. Let's go with the next topic. Now, where to invest? This is a question which I think I have received from a lot of people. So let me just answer this one by one. I've taken 6 asset classes over here where you can actually start investing. First is definitely the savings account or the fixed deposits. Now, what are these things? This very safe, predictable returns, 3% for savings account on FD for fixed deposits in your bank, 7%, 7.5%. I think if it's senior citizen, you get a little bit more, something around 7.5 to 8. I don't remember the exact value, but something around that. This definitely doesn't beat inflation. This is good for emergency funds only. I'll come to emergency funds later. Emergency funds are nothing but, let's say your monthly expense is around 50,000 rupees. Okay, so emergency funds, it's nothing around this multiplied by 6, that comes to 3 lakh rupee. That means if you lose your job today, you should at least have, if your monthly expenses are 50,000, and if you lose your job today, you have to keep an emergency fund of at least 3 lakh, which will help you survive in for the next 6 months without any headache. Okay, this is not really a wealth creation tool, by the way. Second is gold, everyone's favorite. So basically, it's the favorite of our parents. Indians to love Indians love jewelry. So India's most emotional investment. Returns are roughly around 8 to 10% over long periods of time. This is not very very consistent. Gold prices do this for years, and then this, which recently happened, the gold boom, and then it'll again go something like this for years, and again this is how gold moves. So this is not really a, not to generate income. Good hedge against uncertainty, because when the war starts, okay, people panic and they go for safe investments. Gold, safe investments in the form of commodities. It can be gold, it can be silver, crude oil. So gold is one of them. This is also not your primary wealth builder, but I believe this should be a part of your portfolio. Third is real estate. Real estate, as you already know, if you are from Bombay by any chance, or Mumbai, high entry cost, low liquidity. Not just Mumbai, I think even for luxury places and all, even if it is a normal flat, I think a good flat starts from around 1 crore or something. Depends from area to area, depending on people's lifestyle and all. So the entry cost is very high, liquidity is very low. Returns vary wildly by location. Works well for some. This is not for someone who wants to start investing, I believe. Even though nowadays we have something called REITs, we'll come to that part later in our upcoming videos and all. This is mutual funds. I believe this is one of the best things which you should use as your wealth building vehicle for a long period of time. And there's a picture of SIP investment over here. So the entry point is very low, 500. I think even you can start with 100 rupees. That's not really a big deal. You can start even with 500 or 100. This is professionally managed by fund managers. I'll come to that index. No, index part has been explained. This has a return of around 12 to 15. This is the best starting point for most people. When I say 12 to 15, no, don't think that every year it's gonna give a 12% fixed return. It is supposed to be like for 1 year, maybe the return is zero. Maybe next year the return is 20%, 24%, maybe. Then again, the next year it can be minus 5%. Again, the next year it can be plus 25%, 30%, something like this. It is not very much linear. Next, we have direct equity or stocks. So this was mutual funds. We'll have a separate video for stocks versus mutual funds. As of now, I'll just continue with this part. This is direct equity or stocks. Equity is only called stocks. It's no different. This is the highest potential returns of any asset class. This requires knowledge, discipline, and a process. So this is exactly what I have built SR Trades for, so that I can show you guys how to pick stocks, how to invest in them, how to stay invested in a stock for a good period of time, so that you can capture good momentum. By the way, I'll just make a little bit, or I'll just tell a little bit about these two. So a fund manager manages, let's say, 100 crore. Okay, if people don't know which stock to buy, how to time them and all, they give their money. There's a common ordinary man. He's giving his money to the fund manager. Fund manager makes a pool of the money taken from probably lakhs and crores of people. Let's just say crores of people, maybe crore and all. And then he makes a pool of the money, and then he invests that in the market, which is known as mutual fund. So if I use another example, you have bought a car, you have bought a car for yourself, and the second scenario is you have bought a car, but you have also hired a driver. Okay, that is your car, but the driver is driving it. This is exactly the same scenario. This is your money, but instead of you directly investing in the stock, because there are people who don't know which stock to buy, when to sell, you give it to the professional. This is that driver which I'm talking about, and they manage the fund, and they manage the fund by making a pool of that money, and that is how they invest the money in the markets, which is nothing but mutual funds. We'll come to this part again later in some other video that will be very much detailed. This is seventh one, crypto. This is highly speculative, extremely volatile, only if you fully understand the risk. Otherwise, it is not really recommended for beginners. Okay, for beginners, even if they want to try, I still believe I'm not recommending anything. This is only for education purpose. Stable coins are there. I think Bitcoin, Ethereum, these are the most stable coins. I think if anyone starts investing into these particular assets, these are few things which you might start with. Each one has a role over here. As you can see, I've written down savings, FD, safety net, provides you the safety net. Gold is mainly for hedging. Real estate, long term asset, mutual funds, best to start. Stocks, highest growth potential. Crypto, speculative. Okay, so when we make a portfolio, it has to be like, portfolio means this will have probably 10% of this, 20% of this, maybe 30% of this. So 30, 20, 50, and this is what, 60. Remaining these two, 40%. You can exclude any one of them. So this is not something which I am telling that okay, this is where you should invest or something. A portfolio means you have to pick, you have to make a portfolio by picking few asset classes from here. That means I can make a portfolio of mine with probably 50%, 60% of it in stocks, 20% let's say real estate, 10% maybe savings and FD. Or I can again make a portfolio. This depends on person to person. So this cannot be a fixed answer for everyone. They have to go for finance professionals and all. They'll help you with this part. Let's say there's someone um, who wants to play it more safe. So probably they're gonna keep 40% in FD and all, 30% in real estate, then 10% in gold. So 30, 70, 10, 80, and then remaining 20% they can invest in mutual fund. That depends on person to person. Usually, what I know, if people are going towards the retirement, they should start more of preserving their money, so they go for more safety options. But people who are in their 20s or something, they should take the highest risk possible. Next, so this is the real enemy. Now this is basically the last section of the entire thing. Before I close this video, just know this thing: the biggest threat to your financial future, it is not any market crash, not a bad investment or timing the market. It is doing nothing. This is going to cost you more in your future if you do nothing today. Why so? After seeing this video, people might feel motivated for the next 48 hours. Today you're motivated, next month you'll probably think, okay, I'll start next month. And then again, next year you'll be like, okay, I'm going to start next year. And if this cycle continues, you're going to probably start in 1 decade. And you already know if you start late, what is going to happen. If you start late, what is going to happen? So, to counter that, you should start investing today. Okay, the best time has already gone for you to invest. Start your investing journey. Second best time, definitely it's today. I'm not telling you to take risk you don't understand, or put all the money into some one particular asset class. I'm just telling you, start somewhere. I still believe mutual funds are the best, at least for beginners. It's up to you where you want to invest, but start investing as early as you can, so that with time your portfolio grows. Start small. If you have to, start with a 500 rupees per month kind of investment, but start. This is the most important part. Okay, cost of not investing, as you have seen today, is not zero. It never was. So that's it for my first video. Hit a like, subscribe to my channel, and I'll be expecting you all to watch my upcoming videos as well. Thank you so much for attending today.